Well, welcome to our informational webinar, and we're really pleased that you chose to spend this time with us. My name is Grant, and I'm your host. You know, at Gulf Suites and ERC Communities, we're all about diversity in investments, so I'm really pleased to have two experts speaking on this webinar on that very subject. So stay tuned if you're looking to diversify your current holdings. Now, first, I'm very pleased to introduce Ramez Fakuri from the
How are you?
sorry about that. From the IRA Club. Ramez is an entrepreneur with over 20 years of experience providing services in various settings, including hospitality, industry, financial services, and real estate. And as vice president of the IRA Club, his mission is to open doors and opportunities by educating, inspiring, and allowing our investors to diversify outside of the norm. So welcome, Ramez. It's good to have you here.
Grant, thank you for the introduction. Honestly, you probably did a better job than myself, so thank you. I always personally, when I introduce Jerry, I say, Jerry, please, it won't do justice. Introduce yourself. So as many webinars and events and podcasts, and it's just again, I thank you for all both of you, by the way. I love what you do, Jerry. Your team is so. And the best way to put it is education is your first and foremost, because what you guys are trying to do, and to Grant's point, is we're trying to educate people on diversification, and not just their own personal funds, but because we're talking about retirement funds. I thank you for the time and the opportunity to speak about it.
We're certainly glad you're here. Thanks, Ramez. And we also have Jerry Ellenberg, and Jerry has more than 40 years of experience in real estate, finance, and development. And he was the founder and general partner of LCAP Manufactured Home Communities. They acquired over 100 properties, totaling more than 40,000 rental units across 26 states, with over $900 million in transactional value. His expertise includes accounting as a CPA and founder of a public accounting firm specializing in finance and taxes. And he has the vision to create an engaged collective of investors, bringing to light his unique combination of financial and operational experience. Jerry, glad to have you here also.
Thank you, Grant. Can I tape this and run this every time I meet somebody?
Absolutely. You can just have it on your phone.
These are great intros, Ramez.
Yeah, great intros. I'm just like,
Ramez, Grant likes us better than we like ourselves, I think.
Put it on your phone and you just hold it up to people when you meet them.
Right. No, that's great. And Grant, thank you for producing this. It's great to have you as our host, and it's just very nice work you're doing with us here.
Thank you so much. Well, Jerry, we're going to kick off and talk about ERC communities in this webinar. So I know nothing or very little about this, so I'm really excited to learn it all. So I'm ready to roll when you are.
Well, let's go. Why don't we get the first slides up and running here, and I'll walk us through it. This is, of course, a joint webinar of our ERC Communities, a manufactured home rental community development company, and our dear friends at the IRA Club, Dennis Blitz and Ramez Fakuri. We're doing great work with this group on IRA and retirement fund investments, so investment capital coming in every week from their own clients and from clients we are referring to them. ERC Communities is a great opportunity for retirement. For retirement funds. We'll get into that as we move down through the slides. But go ahead, Grant, bring up our first slide. What is ERC Communities? We are a developer, builder, and then owner-operator of manufactured home communities, wherein we buy land, we develop the land, we construct it, we put in all the underground, all of the roads, landscaping, everything, and then we purchase brand new manufactured homes. These are approximate 1,400 square foot, 3-bedroom, 2-bath homes that are brought into the community and are assembled on site, and we then rent those homes out. The rental of these homes, the square footage that we offer, the amenities that we offer, are on average right now coming in at approximately $500, $600, and $700 less per month than the same square footage for an apartment building or a traditional rental home. The strategy of the company is to obviously take advantage of this unique affordable sector. Affordable, by the way, folks, can be a very dangerous word. It isn't affordable like Section 8 or government subsidy. It's straight conventional housing, no government subsidy. These are all working folks who are choosing to live separately instead of living in grouped apartments, and who may not yet be able to afford their own homes. And of course, right now, subject to this tremendous spike in interest rates. Our strategy is to acquire land, build these communities into a large chain of properties. I easily conceive of between 5,000 and 10,000 rental units over the next decade. We will retain ownership of all the homes and maintain them ourselves. And I have a lot of experience that in landlording. So that's basically the strategy, starting in Florida, which is a great place to launch this, given the growth that we are experiencing down here. And because of that growth, tremendous affordability problems, getting very hard to rent places, very hard to buy places. So we're buying land in slightly outlying areas where the commute might be 5 or 6, 7 miles longer, but the rent savings, compensates for that. So Grant, that's what we're doing. Okay, what is the opportunity? As I just said, it's affordable housing, build to rent. These homes are being brought in universally to rent. We're not going to sell them. We're going to keep them uniformly and house these homes, or lodge these homes, as it were, in large communities. Our first one in a suburb of Tampa right now comes home at 165 units. Total development cost in the $32 million area. We have now just broken ground on that. Literally have just broken ground. That's the product. Okay, the middle box is the basic objective financial incentive. Is twofold. Number one, we pay a 10% annual dividend. We send it out quarterly, 2.5% quarterly. That dividend is largely tax deferred. Probably no tax on that dividend for at least the first half a decade, maybe longer, based upon soft expenses that we're able to deduct under current tax law. Soft expenses are expenses that we're able to deduct but don't cost any cash, primarily in the world of depreciation and amortization. The third circle there talks about Regulation A. Regulation A it's actually an old piece of securities law that goes back several decades, but was renewed and lengthened, or let's say increased in size, with the Jobs Act of 2012, which encourages sponsors like myself and companies like us to work with Main Street investors to come in and take advantage of new opportunities that have heretofore been set aside for wealthy investors. It is truly it's a democratization. It's kind of an equal opportunity investment scenario where everybody can invest very small sums of money if they want, very large sums if they want, and designed in a way that has us keep management control tightly together, prevent raids from big corporate raiders. It's a very nice design. And within Reg A, we call that Reg A, by the way, REGA. Within that design, we have designed all of these shares to be what are called preferred shares. I always tell everybody when they hear the term preferred shares to get on Google and look that term up. It essentially means first money out. So we sell these communities in 3 years, 5 years, 10 years, whenever. All the money goes to the Regulation A preferred shareholders first until they get all of their investment back, having also been receiving their dividends through all those years, and then we share in profits all together. So it's very key that the investors see that there's 3 key attributes to the investment. Attribute 1, tax deferred dividend at 10% could be, and Ramez can chime in on this, could be effectively a 13% pre-tax yield. Number 2, preferred stock, first money out. And number 3, a very nice opportunity for growth. And we'll talk about how that growth occurs later on. That's basically what we're doing here, Grant. So go ahead to the next slide. Market dynamics. Well, what are the market dynamics? I mean, you don't have to be watching CNN, CNBC, MSNBC, Bloomberg, Fox News, Fox Business. It's pretty hard to avoid the news of what's going on right now. Tremendous affordability problems. This is coming home in the world of rent. Brand new apartments right now, 2-bedroom, 2-bath apartments here in Metro Tampa, $2,400, $2,500, $2,600 a month. 200, 250 less square feet 3-floor walk up of stairs, a 100-yard walk to your car. We're delivering a home that's larger. You walk 20 steps to your car because it's right in your own driveway, and we're charging, $1,700, $1,800 a month rent. It is turning out to just be a delightful demand that we're seeing from the tenant base here in the county in which we live, Pasco County, Florida. The county economic development council has asked us to advise them when we start taking delivery of our homes on our sites. I asked them why they want us to call. They said, Jerry, tell us how many rental applications you want, because we have 6,000 people looking for homes right now and they can't find them. Companies are not moving here now. They're refusing to move here because they can't find enough housing for the people. So the demand is just off the chart. That really is the market dynamic. The rent savings and the ability to live in individual homes is a unique combination. Instinctively, young America instinctively goes to an apartment. I mean, that I did that as a kid. Ramez, you may have. I mean, everything starts in an apartment, and that's probably where we will gather the bulk of our rental demand, is people who want to get out of that grouped living. They love the swimming pool and they like the recreation center and the social center, but maybe they have a child or two now and they want that individual living where they can, just really have privacy. So that's really what the product offering is. The demand here on our initial unit count, this initial 165 units is in 3 pieces contiguous. The first 60 units we advertised on Zillow, and we had 200 reservations in 2 weeks. That is literally the demand of this right now. So it's frankly a no-brainer in terms of its feasibility. I'm going to have to put my glasses on for this, folks. Well, I actually have gone over this a bit. Our strategy is unique in that traditionally manufactured homes are brought into these communities and are sold to the residents. We are not doing that. We're not going to be in a resale operation. We're not going to order custom homes that take different types of time frames to deliver. We're ordering very consistent design. We're flipping the floor plans. We're doing a multiplicity of colors to give some nice variability to the community. But we are essentially saving tons of money by doing a consistent design, and we are going to rent the homes out. The number 2 there talks about that initial 60 home facility, which we already own and are constructing right now. Next to that 60 units, we bought an adjoining 60 units, and next to that, another 45 to come to a total of 165 all in one community. Probably a 30 to 35 minute commute to downtown Tampa, 15 to 20 minute commute to all of the major employment areas. Portfolio scale is kind of where I live. I did build up a large collection of properties. Today, I'm a part owner in 7 properties across the country, collecting rent from about 6,000 families. But before I sold off the syndicated properties, at its peak, it was 26,000 families on the rent roll. So I have a real scalability mentality. My partner in this business, the company's president, Ryan Koenig, has 2/3 of $1 billion of construction completions on his resume. So he's very immune to widespread growth, developing 3, 4, 5 communities at once. So we think we're going to have a great development spurt. The exit opportunity is interesting. It does say here institutional investors, national rental operators. That is a possibility. If we were to go to national rental operators, we would probably want to deal with public REITs, because in doing a sale like that, the sale becomes tax deferred. You can exchange your ownership in ERC at that point in time down the road to, say, a Post Properties or a Leisure Lifestyle or Sun Communities, any one of these various REITs that own apartment buildings, manufactured home communities, et cetera. We could indeed form an IPO ourselves. We could take this public as a New York Stock Exchange REIT. That's a pretty complex exit, but it could be very profitable for us. We will, when comes time to sell, my background is such that we will fully explore tax incentivized sales. Target markets right now, it's pretty obvious that we're in our home state. This state is soon going to be the largest population in the country. It's essentially California all over again, absent the political environment there. You see some concentrations there on the Florida map. The Panhandle, you see Western Florida there, which is where we live, Central Florida, and of course, up on the top right-hand side, you see Jacksonville. These are all wonderful areas. I mean, Tallahassee, Pensacola, Tampa, down to Sarasota, Naples, over to Miami, up to West Palm Beach, and all the way up the coast to Jacksonville, and of course, certainly Orlando. These are major metro areas that have suburban outlying areas that can support this product very nicely. We then include the map of the kind of the what I call the 3 o'clock to 6 o'clock on the American map, the kind of the, you know, the what would you call the southeast quadrant, and going as far west as Texas. That is a very, very acute target area for us because of employment growth. And if you look at these states, these are very easy states to live in. Housing is more affordable. Employment's coming in, and that is where you will see us go. My guess is we will probably get up to 2,000 or 3,000 units in Florida before we start going outside the state, unless unique land opportunities come up that just present themselves, and we obviously, you know, can construct efficiently. Why ERC? Why now? Number one, fastest growing segment of the housing market. You can get that from any element of press that you want. Build for rent, build to rent. Conventional is huge right now. Interest rates are driving home buyers away and forcing them to rent. The affordable housing crisis I've pretty much already gone through. We are offering as much as a 25 to 35% reduction. We don't even know what's going to happen with these rents over the next couple of years, or we keep redoing feasibility studies and the rents keep going up and up and up. And so we think we're going to have a very nice, yield return here. Target market, take a look. 30, basically a third of your millennials own homes versus almost 2/3 of Gen X and 75% of those my age. So you have a cultural shift, I think, that's driven both by personal need, personal taste, and financially. People, when I was a young man, I mean, all that mattered was buying a house. These days, not so sure. There's all kinds of affordable investments like these ones that I'm selling here and others. And so people aren't necessarily inclined to just automatically buy a house. So there's good rental demand. Our culture is changing away from traditional home ownership, and we basically want to be the catcher's mitt of that opportunity and capture it as it continues to grow. Leadership here, you can view me as basically the financial guy. Our president, Ryan Kenny, who I've done business with since 2009, we've known each other for 13 years. We jointly owned a home building business wherein we did about a couple hundred homes. It was a rather small business, did a lot of purchase and rehab and resale. It was very part-time for me, but we got wind of this build for rent building up, starting with some of the major hedge funds to whom we were selling homes, and decided to go into this ourselves. I come to the table with basically the financing background, running, of course, the sale of these shares to folks like you. Ryan comes to the table with land acquisition, entitlement, permitting, general contracting, all of the bidding, all of the construction budgeting. We have major lenders dealing with us now for construction and mortgage financing. Ryan just eats that stuff up. He knows exactly that world. He's done construction work with the California Public Employee Retirement System, with Turner Construction, with Camden, with Wood Partners, with Zarimba out of Wisconsin, huge organizations for whom he has done construction superintendent work. So you're in very good hands with Ryan in terms of developing these communities. And these communities, in that there's no vertical construction, that the actual homes themselves are purchased and brought in, there's a tremendous lowering of operational risk in the development construction stage. We think that's a major thing for investors to look at. You're not risking about 20 different trades of foundation, framing, sheetrock, tape, texture, finish, paint, roof, air conditioning. All of that stuff is done at the factory level and brought to our site. So it's a very minimal risk, comparatively speaking, in the world of construction. Ryan has very good control over that. He's also available to chat. if any investors want to get a better firsthand view of what this is development-wise. How to invest, there it is. We'll also talk about this at the end. We have a couple of different websites here. We are selling shares on Reg A, investors@erccommunities.com, and invest.erccommunities.com, I think, is where you actually go to buy the shares. I think at the end here tonight, we have some phone numbers that you can call to reach us. So that's pretty much my deal. I think it's time now to talk about retirement planning and switch over to Ramez, which is as critical, if not more critical, topic what we're going over here today.
Thank you, Jerry. We really appreciate that. Ramez, are you ready to roll? You got your PowerPoint?
Ready to rock and roll, buddy. Gonna go ahead and
get out of your way, man.
All right, well, Jerry, thank you. Let me go ahead and take a quick gander back and take a step back, because we are talking about something that is real near and dear to me, which is retirement accounts. And Jerry's absolutely right. We are in a crisis. One of the things that I do like to bring up to people is the power of a self-directed IRA. When you hear me talk about self-directing, and before I get into the company overview, self-direction is just a marketing term we use within our industry. Self-direction is about one thing and one thing only. It's called control. So when people think of IRA Club, I want you to go ahead and think of Fidelity, Vanguard, Schwab, TD Ameritrade. I always refer to these four companies because they are the four horsemen within our industry. They control 70% of all retirement accounts. So again, when you think of IRA Club as they are a trust company, we are a trust company. The only real differences between them is they're only allow you they're gonna only allow you to invest within the norm, right? Stocks, bonds, mutual funds, ETFs. So many of you that have a 401k or an IRA or a current 401k, 403b, or a 457, many of you are feeling a lot of, and Jerry's smiling at this, but a lot of anxiety as your retirement portfolio just keeps on dropping this year. In fact, year to date, I think it's just over 20%. I don't know. Hopefully we rally a little bit. But with that being said, IRA Club allows you to not only invest in the norm within stocks, but we also allow you to invest in the alternative space, allowing you to take a portion of your retirement funds, if not all your retirement funds, and gives you the flexibility to protect yourself in this aspect against a downturn or a market correction, because we all know how that turns out every 8 to 10 years. Jerry, we know this last 14 years have been fantastic within the market. Not so much, and I think it's here to stay in the aspect of inflation. Taxes are going up, which are things I'm going to get into a little bit later. IRA Club as a whole, based out of Chicago, Illinois. We've been here for 15 years. We have 12,000 IRA Club members, just under that. We manage $1 billion in assets. The majority of that is in the alternative space. We have 35 full and part-time employees. As I mentioned, the true benefits behind self-directing is control, giving you the flexibility to invest in what you know and understand best. So if we're talking about real estate, because the majority of what we reside in here is real estate, truth be told, ERC might be a great platform or opportunity for you to take, again, a portion of your retirement funds to invest tax-free or tax-deferred, something I'm going to get into later. But for me, the icing on the cake is going to be the fee structure. One of the reasons why Fidelity, Vanguard, Schwab, and TD Ameritrade hate IRA Club, full disclosure. But again, Jerry's smiling, and he knows the reasons why behind that.
Get sure you want the truth.
I know what you're going to get into.
Say this on a public webinar. My dog is gnawing at me here, and I'm trying to keep her from making noise. So, just to let you folks know, we're kind of a down-home company here, huh, Ramez?
Yeah, no, it's full.
I'm trying to keep her quiet. I'm dog sitting while I'm doing this webinar. This is terrible.
No, but the real question which falls is a question is you should be asking yourself is how safe is my retirement today, right? There's too many things working against your retirement. I just mentioned the stock market volatility. We always mention there is a market correction every 8 to 10 years. Taxes are on the rise. That's because the new Inflation Reduction Act just passed, right? We have to come up with $4 trillion. Every single government program that we have is completely destroyed. Not to mention pensions are no longer offered. And I'm going to talk about this in a little bit greater detail. Inflation's here to stay. If all these things are working against your retirement account, what if I brought another light to fruition? 64 million IRA accounts across the country, of which only 60 million have $1 million or less. Okay. Whereas 1.8 million IRA accounts have $1 million or more. My question to everybody that's listening is, what are the 60 million doing wrong that the 1.8 million are doing right? And the answer is really simple. They have to be able to self-direct their way to retirement. All right. Otherwise, you're going to be working forever. You got to be able to create double-digit returns within your retirement. Now, before the 401k, before the 403b, before the 457, it was the IRA. All right. They all stem from the IRA. The individual retirement account, established in 1974, was really to address pensions. Congress quickly realized less and less companies were offering pensions. What they didn't take into consideration were every single government program, as I mentioned, is completely in shambles. Now, 40% of all retirement accounts, of which only $40,000 is the mean and or average across all qualified, again, retirement accounts. That is not sustainable. This is not something that we could live off, and this is adding general strain to our government. Not to mention $1,500 is not something that we could live off of, especially this day and age. When Social Security was first established back in 1935, there were 24 workers for every one retiree. That is because the average life expectancy back then was only 58 years old versus today, 78 years old. So the ratio today is 2 to 1. By 2030, that's going to be 1 to 1. Not to mention 28% of Americans over the age of 60 don't even have retirement accounts. Jerry brought this topic up real quickly. Millennials. Millennials are not helping retirement accounts at all. As you can see, there are $33 trillion sitting within retirement accounts because that is the majority of the U.S. wealth. It sits all within retirement accounts. It's really the Gen X's and the baby boomers that control that. Millennials, as you can see, haven't even started, nor do they care to start. Now, I'm not going to get into too much about the inflation and taxes because the majority of you that are probably listening to this are sick and tired of hearing the broken record, right? Inflation is here to stay. It is not going anywhere. You could simply not put $13 trillion into the economy the last 2 years and think for 1 second inflation is going to dissipate anytime soon. We need to get that number down to 2%. And in doing so, Mr. Powell has told us very clearly, expect rates to jump 3 to 5 more percent. 3 to 5 more times within the next year. Now, is that going to help? Not sure. We'll see where that leads to. But again, I think we have a long ways to go to get down to that 2% marker. Not to mention the cost of living, $6,500 is the average right now per year per individual. Now, as investors, I'm going to tell you this. We are heading into a tax storm. In particular, people that are in the highest tax bracket. According to the Inflation Reduction Act that just passed a few weeks ago, well, they have to come up with $4 trillion. So who are they going to really focus on? It's corporate America. Anybody that's making over, and when I say anybody, I mean any company or corporation that's making a net income of $1 billion will get hit on a 15% tax. Now, when it comes to your IRAs or employers' 401ks or 403bs, there is a 1% tax if you decide to buy and or sell. So why am I telling you this? I have a feeling if anybody's getting an employer match of 4, 5, or 6 or 7%, I think that number is going to drop. I think it's going to drop almost a full percentage point. You need to be aware of that as an employer. So the other thing that I want to bring to everybody's attention is one of the things that Biden did promise and Congress is we're not going to raise taxes on middle to lower class America. And I don't want to say middle to lower class, but I want to say net income, right? So when we think of net income, you could take a look and see which category you fall into. What I want you to concentrate on is the number of audits that are going to be happening on a yearly basis. Why? Because Congress just empowered 87,000 new IRS agents and $80 billion to go after middle to lower America. So we're not going to raise taxes on you. That's the point that I'm trying to make. But we're going to go ahead and get after you with hiring new IRS agents versus the wealthy. I just mentioned they're already raising taxes across the board. So when you take a look at these numbers, it's drastically different. There's no reason to go after them. So again, I know these numbers are a little bit lower on the downside. That's because most Americans are not making $5 million or more, but I do want you to be weary of this. Now, IRA club members, right? This is what they're ultimately always thinking about. How do I get rid of Uncle Sam? Because they're not only looking at their own personal dollars, they're also looking at their retirement dollars when it comes to investing. So the best way to do this is, as Dennis Blitz, president of IRA Club, refers to this, a gift. I refer to it as the most underutilized gift in the way that we invest as Americans, right? This has only really been taught to accredited investors. That's what bothers me. This is the reason why Jerry wants me to talk about this, because when we talk about ERC, he mentioned a Reg A, right? This is for both the accredited and non-accredited. This is why I take great pride into not just talking to accredited investors, but non-accredited investors, because the majority of you, let's face it, they don't want your money right now in the stock market, right? We're looking at alternatives right now. The problem is most people just don't understand it. When I talk about self-directing and an underutilized tool, think about this, all right? If you could take a portion of your retirement funds to invest, hypothetical, let's just talk ERC, your ROI jumps 25 to 50% versus using your own personal your own personal funds, because you are taxed. And we're going to go ahead and give a quick example of this, or better yet, a case study, versus tax deferred, all right? So which is a traditional IRA versus a Roth IRA, tax free. So we all understand this as investors, all right? When it comes to retirement accounts, they're all governed by the same set of rules and regulations when it comes to investing. The only difference is, right, is how much you could contribute and when do you pay the taxes. Traditional, it's tax deferred. You take the deduction up front and you pay an RMD at the age of 72. Next year, actually, that jumps to 73. So versus, versus the Roth IRA, you pay taxes up front on the seed, all right, and the growth, the capital gains that you make is tax-free for the rest of your life and your spouse and your heirs up to 10 years. So if we take a case study, so you understand the difference between personal, deferred, and free, I like to give this analogy, this breakdown. If you go to IRA Club's website, they got this great resource, a breakdown of a tax deferred, tax-free. Now, Jerry talked about 10% returns on investment. If you were, for the next 10 years, knowing where we're heading, market volatility, inflation's here to stay, and you wanted to use a portion of your retirement accounts to invest in ERC, hypothetical, and you wanted to roll over $100,000 from Fidelity, Vanguard, Schwab, or your fiduciary or registered investment advisor over to the IRA Club, and you wanted to invest, again, $100,000, look at the difference in payout after a 10-year grace period. So if you use your personal funds, it would be 302 versus deferred 355 versus tax-free 401. That $100,000 would give you a net profit of 301 that the government can't touch 1 cent. But the problem is, who's in the driver's seat? It isn't you, right? It is, when I say it isn't you, it is because most people don't understand that this is an option for them, right? 97% of Americans traditionally hold their retirement funds within 3 places: banks, annuities, and the stock market. Now, for the sake of time, bank CDs and annuities, I'm not going to get into when we talk about numbers, but when you think of bank CDs, it's not compounding, it's simple interest. Always think compounding, and always think better than 4%, please. Okay. That's why we're all here, is to educate ourselves to create double-digit returns. Annuities, the one takeaway that I want you to understand are they're not retirement accounts. These are insurance policies. Biggest takeaway from these are they're very unflexible. You're not in control. You will roll over a portion, and God forbid something happens to you, they ultimately win at the end of the day, and they're not FDIC insured. But I do want to talk about the market because, again, 92% of retirement accounts sit within the norm of the market. But in particular, I like to concentrate on these four companies, especially Fidelity. Fidelity was the first to launch the employer's 401k. They control 33% of all retirement accounts, just under, I believe, $8 billion. I think it's like 7.7%. Sorry, not billion. I said the word billion, Jerry. It's trillion. My apologies. It's trillion. So I want you to think about that. So these four companies control it all. And what we're trying to do is to educate you to move over a portion of your 401k or a portion of your IRA to invest outside of what is currently going on. And these numbers, in my personal opinion, are unbelievably skewed. So when I talk to you about that 8% return on investment, that also includes the 2021 returns, right? Most 401ks sit within mutual funds, employer plans. When you think of this, I want you to think of large, mid, small, international stocks and bonds. So when you dump $13 trillion into the economy, this is what typically happens. Now there's a correction happening. These numbers will tailor off and drop off. So again, what I want you to think about is the truth behind these plans. You are not in control. They're designed to benefit them, not you. And then what they do is create artificial restrictions. So if you were listening to this webinar right now, and Jerry just talked to you about this investment opportunity with ERC, and you were to walk up to your fiduciary or your brokerage firm and you to say, I want to move over a portion of my retirement funds over to the IRA club, the answer is going to be no. You can't do this. That isn't part of the portfolio. This is an artificial restriction. What they're supposed to be saying is, okay, we don't do this. This is another option. So this will always leave you misinformed and misguided at the end of the day. And the most important thing is you lose opportunities while you are the one taking all of the risk. Remember something, if your money's tied into the markets, the only time you make money is if the market's up. The market is flat or stagnant, or if the market's down, they still make money on your money while you lose, or you're the one taking the biggest hit of all, because you're giving up the most important thing in your life, and that is called time. There have been 12 recessions in the last 50 plus years. I'm not going to go through all of them. Again, don't have the time, but within our lifetime, assuming you wanted to retire at the age of 60, let's just say again, simple math, you had $100,000 to start at the beginning of this year and you lost 49% of that. Okay. .com bubble, the Great Recession, you would have to work an additional 4.6 years. So you would have to, just to get to that break-even point of 100,000 again. So I want you to understand that you're giving up time. All right. So, and you keep adding to that. The only time that you could touch your your current employer is if you leave your job, you're furloughed. If you're over the age of 59 and a half, you may want to ask your current employer if you could at least pull out the contribution limits. It doesn't hurt to ask. 8 times out of 10, you might get a simple yes and or no, or you could move over X, Y, and Z dollars. So ask. It doesn't hurt to ask. The real concerns I face here at the IRA Club, again, is lack of knowledge. Most investors are not savvy. The one that I like to know, the one that I laugh at all the time, am I too old to get started? When are you ever too old to get tax-free growth or deferred? Remember, I told you the average American lives until just over 78 and a half. And risk. Most people are afraid of self-directing because of risk. But when me and Jerry, we take the time to educate people on, please forgive me, taking educated, calculated risks. I think that is unbelievably important. I think that you have to do so at some point. And fiduciaries, brokers, registered investment advisors are the other challenge that we face, because they're ultimately trained to keep the funds within the brokerage firm, right? And I will tell you, about 50% of fiduciaries and registered investment advisors don't even know the process of self-directing. They actually reach out to us because they've never heard of it. But the most important thing is you have to understand something. They also have to make a living. So with that being said, it's more easier to hide hidden fees versus fully disclosed fees. But this is a very important topic that you need to better yet understand, because 62% of Americans don't even realize that there are hidden fees worked into their employer statements. In fact, only 18% of Americans could actually calculate these fees. So when you go home, and if you have the opportunity, because I asked many IRA Club members, when was the last time you looked at your current employer's 401k? I will tell you, 95% of them have never even looked at it, okay? These are the terms that you should be looking for. They're little small fees. You'll never feel them, all right? They're worked into the statements. I always refer to them as termites, just eating away at your retirement. Now, when it comes to these fees, and when you include management fees, they're traditionally between 2 to 4%. Why am I saying this to you? IRA Club has a flat fee model. It's $175 per year. We don't care if you have 10,000, 100,000, or 10 million. That does not change the 175 administration fee. The only time that we actually do make money is when you make an investment, right? The $135, because that is the one thing that we can't do for you, is choose the investment for the investor. It defeats the purpose of what a self-directed IRA is all about. So when you think of fee structures, I want you, again, same numbers that we did last time, $100,000, the next 10 years, 10% returns. IRA Club is going to charge you 0.3 versus the Fidelity's, Vanguard, Schwab's, or if you're using a fiduciary, between 2 to 4%. All right. That's going to save you just under $93,000. So let's go back to that one slide when you use personal funds versus traditional versus Roth. So if you were working with IRA Club, us being your administrator for the retirement account, we would not only would you save tax-free or tax-deferred, but we would save you $93,000 of investable capital to do whatever made you happy. That is a staggeringly big number. Lastly, the process. Most people do not understand this process. It's unbelievably easy. Open Fund Invest. Open, you could go to iraclub.com. .org. We own both URLs, both domains. You need 3 things: your government issued ID. You could upload that through Persona. It'll take you straight into the application. Make sure you know your social security number, and that's it. You'll receive a phone call from your IRA Club specialist instructing you on your next steps. Funding. There's 3 ways that you could fund: contributions, IRA to IRA transfers, and old employer rollovers. Contributions are done through Plaid, very easy. We connect to all 12,000 banks across the country. It goes straight into your IRA account. IRA to IRA transfers and old employer plans are the 2 most common ways and the fastest ways to get funds within any one of those brokerage firms over into the IRA account. And again, the last thing I can't do for you is choose the investment for the investor. If you want to learn more about this, and I honestly would highly recommend you pull out your phone, scan this QR code. You got to have direct access to me, book a time that best works for you. There's great guides, an investor's guide that does a thoroughly great job or breakdown. You could go straight to our website, Google me, Google Links, LinkedIn. And honestly, at the end of the day, Jerry knows this better than anybody. All we're trying to do is open up doors and opportunities for you to think outside of what you've always been taught, right? And you have to, again, be able to create double-digit returns. Otherwise, you are going to be working pretty much forever.
That was such a great news to end with, Ramez. Thank you for that.
That's true. Well, I mean, it is true. If you think about it, Grant, that's like, you cannot, like, when you talk about the average cost of living, and if you were just saying the standard 2.9% inflation, the $50,000 that you're currently spending this year, within 30 years, it would be $117,000. So why am I saying this to you? You have to outpace inflation, number one. You have to be able to create double-digit returns. You can't rely on the standard 7 to 8%. The fee structure is killing you, all right, as I mentioned. And these are all things that most people just do not know.
You guys got some time?
Let me add in, Grant, a couple of key comments. We convert a lot of shareholders over to IRA Club. And it's interesting. The investors themselves are basically like, "Oh, we can do that?" And go, "Yeah, you can." And it's quite simple. And our batting average is huge on this. I mean, certain people just don't want to. But if it's, we didn't know we could do this. No one told us we could do this. Worse than that, Ramez may not have been too close to this transaction, but his company got a large investor the other day, about 2 weeks ago, about $100,000 IRA, coming from a major brokerage house. I have no problem saying who it was. It was Merrill Lynch. And they just made his life impossible to try to get it out. I mean, they were telling him you can't, which is a violation of law. I don't know who it was. It doesn't matter. He got it out. He made the investment with us. So so whoever's seeing this webinar, be prepared for some obstinacy. Be prepared for some opposition. And I'll end off with this: self-directing IRAs is going to the polls to vote. Who you vote for is up to you. Vote for ERC, vote for Golf Suites, vote for Timbuktu. It's more important to me that you go to the polls. Get your funds into the IRA club. I am pushing my salespeople who are converting these IRA people to do more than just the ERC investment. Go into the IRA club with a larger sum of money, if you have it, to then look at some of the other investments the IRA club has available, because you should diversify. And the only way to diversify is to go to somewhere like Ramez's company, and they do such a phenomenal job. Our shareholders just love this company. So I'll end off with that.
Cool.
May I add one more thing, Jerry? The reason why I personally love ERC and Golf Suites, okay, not just hear me out. And I'm personally invested with Golf Suites, all right? I'm not using retirement funds, I'm using my own personal funds. But with that being said, you have the best of both worlds, right? For the accredited and non-accredited. Accredited investors have been really the forefront in understanding this concept of self-directing, right? It's the non-accredited investors that I want them to understand that this is also an option for you. You don't have to be tied into your employer plans. And Jerry just so happens to have a Reg A offering tailored for both accredited and non-accredited. And Jerry, if you don't mind me asking, what is the minimum investment for ERC? I never asked you that.
It's only $750. And so it's very easily obtainable. We have investors coming in, as you know, Ramez, for massive sums in both companies, but we also have investors coming in for the minimum. And we have investors, we have an automatic reinvestment plan now. We have 2/3 of our investors don't even want their dividends anymore. They want to reinvest them. We much like what you have at the IRA Club, Ramez, you have a collective there. And so do we. I mean, we really have an investor commune here. And they just, it's like the old TV show Cheers. I mean, they know each other. They refer friends. It's very touching, actually. I have trouble hearing myself even say that, because the bulk of my experience in my life was all institutional, all Wall Street based. And this is now Main Street based. And it's just a very personal, very relationship oriented. And, it's very touching, actually. Sounds kind of corny, but it is.
You're such a soft touch, Jerry.
I am. I mean, I'm just a mushy guy. Just trample all over me.
Grant. Yeah, we got you. Yeah. Well, that's really cool. Do you guys have time for some questions?
Yes, I think we can take a couple. I think we've covered a lot of stuff, but throw us a couple of questions. Sure.
Well, Jerry, you in your chat that you started with, you said the word REIT, if I heard it right, several times, and I'm not sure what that is. What is a REIT?
A REIT, those letters are REIT, Real Estate Investment Trust.
Okay.
They were invented sometime. That's another thing that's very old, but wasn't used very much until you got into the 70s and 80s. They're very popular now. A real estate investment trust is a corporation that does not pay any income tax to the degree it distributes 85% of its profits in dividends. Now, that's an interesting word, taxable profits. Well, what do real estate investment, what's their biggest expense? Depreciation, amortization. So you might have $100 of net cash flow. You only pay tax on $50. So if you distribute whatever that would be, $42.50 of the $50, you're qualified, and you keep the other $57.50 for growth. Again, that's what I call 13th grade, but the REITs are there's multi-billion-dollar operations under real estate investment trust. That's where ERC goes. ERC goes probably in that direction 5-8 years from now, either merging with an existing REIT or forming our own. But REIT means Real Estate Investment Trust.
Okay, thank you. Jerry, another one for you. We just went through another hurricane. Hurricane of the Month Club, I think, is happening in Florida right now.
Yeah.
How much of a concern is that for your community?
Well, we're not building these communities near the shore. we're building them on high ground. High ground in Florida means like 100 feet, but at least there's no flooding. And when you're on the coast, you're of course concerned about flooding. You're concerned about wind. We certainly get rain. These homes are all built to HUD and FEMA requirements. They're assembled to those requirements, each home fully inspected. And all of your inland situations here in Florida, these 2 hurricanes we just experienced and a handful of tornadoes, there were no damages of any kind. There was some damage right on the beaches because there are some communities there, but we won't develop there. That's too risky for us. So you're very safe here in this kind of product.
Ramez, I have a 401k, and what if I wanted to withdraw my money or part of my money or whatever? How do I get hit with taxes? What happens there?
So, and let me backtrack and ask Grant, is it with your current employer, or is this an old employer's 401k?
Old employer.
Oh, it is. So absolutely not. So the way that it would work is we would establish an IRA, or if you qualify for a solo 401k, we would establish the account here at the IRA Club, us being the trust company, and our team would help you roll those funds over from wherever they're currently at over to the IRA Club. And then once the funds are here, choose your investment. And then the beauty of IRA Club, and the reason why Jerry loves IRA Club, it's a true system of checks and balances, right? IRA Club will literally handhold every single one of Jerry's clients through the entire process. So when they call, we're not a call center. Let's backtrack and say that first. You get a receptionist. You ask to speak to your IRA Club representative. I don't know what to do next. What form do I need to fill out? What is this? What is the requirement over here? Am I causing a prohibited transaction? If you don't know the question the answer to the question, call.
Cool.
Call. That's the beauty. But we'll walk you through the entire process, A through Z.
And I want
It's
to ask
pretty
you another
smooth,
question.
Grant. It's very smooth. Listening to we must have, what do you think, Ramez, 3 or 4 or 5 dozen investors over there with you folks now. Never heard a complaint.
More than that,
okay.
Jerry.
Yeah, so it's a lot of people. It's happening every week. We have 2 investments today that are processing.
Yeah.
We never get no complaints of any kind. It's very IRA Club's a nice mom and pop company. It really is. It's an old culture that's being lost in business in general, and it's very nice the way they treat our people.
Ramez, I want to ask you one more question. You talked about the fee structure. I want to make sure I got it right.
Yes, sir.
It's $170 something a year.
So it's $175.
Okay.
And the reason why, and let me backtrack and say versus, and the reason why I say this to people is I really want them to understand this. For every $100,000 that you have with a traditional brokerage firm or fiduciary, bare minimum, they're taking from you $2,000. Bare minimum, whether the market's up, flat, or stagnant, it's a bare minimum of $2,000. So the reason why I tell people that is $175, there is no hidden fee structure on the back end. The way that we make our money is per asset, per investment. So it's $135 per investment. All right. And we'll do the work for you as far as the paperwork. We don't want you to be the bookkeeper. Do we have checkbook IRAs? Do we have everything else that you would need? Yes, of course. But let us do our job for you. That's the whole point of this.
Well, plus we pay the fee, Ramez. People that come in.
Jerry, I wasn't supposed to say that. You said it. I didn't say it. So you took, you said it. I'm happy. It's over. I didn't want to steal your thunder.
We are
happy
recording.
to do it. So yeah. So if you're investing with either of these companies of ours, we pay the intro fees and which is very, very nominal. That's why we do. But it's a nice service that we try to provide our investors.
So if I have this 401k account that I want to convert part of whatever, and I bring it to you, and I'm telling you that I want to put some of my money with Jerry, with ERC or Golf Suites, which we really haven't talked about. We may want to touch that at the end, but Jerry's going to pay those fees. That
our company pays that fee. They bill us directly for your fee.
And if I want to invest in Joe's Lemonade Stand, then I would pay that fee on my own.
Yeah.
Yes, that's on your own. Correct. 100%. So what Jerry's basically doing is talking about Streamline. He's going to educate you on his product, on the investment opportunities, talk whatever it is that we need to talk. We're going to go ahead and establish the IRA account. We'll answer any questions that you may have about self-directing or the process itself. We fund it for you. And then lastly, Jerry's team would provide the investment docs over to IRA Club, and the funds are released the very next day. There are no fee structures when you work with Jerry, ERC, and Golf Suites.
Cool. Very nice. Jerry, give us 60 seconds on what Golf Suites is. We never touched on that today.
Golf Suites is for those people who may be seeing this webinar, if you have familiarity with this national chain called Top Golf, we are essentially a Top Golf competitor, a Top Golf clone. This is golf driving range, open air, 250-yard driving range, floodlit, golf balls, golf clubs, and 40 to 60 bays where you go in, and we have television screens that have you pretending that you're playing at any one of a number of major golf courses, combined with sports bar, heavy food and beverage, hard bar, hard liquor, wine, beer. So it's an extremely social environment, probably about 2/3 food and beverage. Top Golf itself is concentrated on super large facilities in core urban areas. We're doing more secondary areas, going to a lot of the university towns. We're in Tulsa, we're in Lubbock, we're in Baton Rouge, we're in Jackson, Mississippi. We're now going into Auburn, at Auburn University, Alabama. So we'll build smaller facilities that we can build faster and have a faster speed to revenue. It's a higher yield asset because it's a very management intense asset, whereas ERC is passive income. It's a landlording activity. So the companies are very different. The ownership structure, ironically, Grant, of the company, both at the holding company level and now at the public shareholder level, it's just homogeneous. I mean, everybody's just investing in both companies. And we thought that would be a problem at the outset. And we're just amazed that we just have people come in and they get mad at us if we don't tell them about the other company. So whereas at the beginning we wanted to keep it very separate, and just better be careful. But of course, it's disclosed in the offering circulars that I am chairman of both companies. When we founded it, a couple of my founding shareholders said, Jerry, it should just be a single company with 2 divisions. It very easily could have been, but it's 2 distinct companies, similar founding ownership, and now at this point, very similar, very synonymous public shareholder ownership. So it's
Cool.
Very happy campers, both companies.
And so
That's it in a nutshell.
I'm sorry, Ramesh, I want to double check then. So this same investment opportunity using my self-directed IRA works for both of Jerry's companies.
Yeah.
Correct.
Okay.
Correct. And full disclosure, any company, anything that you're ever in, basically anything that your heart desires, as long as it's passively going inside back to your retirement account, your IRA or solo 401k, outside of really 2 things: collectibles. You cannot invest in antique cars, antique rugs, or that rare bottle of wine, and you could not invest into an S corp with your retirement account, obviously, because you're getting the tax benefits.
I think one thing you should add too, Ramez, that if a guy like Grant or anybody else comes over to IRA Club, they can also do stocks and bonds. They don't have to do direct participation assets.
Jerry, people here, when they hear me speak, they think I have an issue and or problem with the markets. Absolutely not, right? We've all made money in the stock market, right? It's just, I always treat my retirement account like a game of Monopoly. It is a game of Monopoly. You just have to know when to be in the market. You have to know when to pull from the market, when to reallocate your funds in the alternative, when to do. So it's just right now, everything is working against you. And how do you protect yourself? Alternatives, ERC, golf suites, hard tangible assets, precious money, whatever your heart desires. It's just I personally and the IRA Club cannot choose the investment for you.
Right.
That's it. Otherwise, you stay with Fidelity, Vanguard, and Schwab, and you take your chances on losing another 10, 15, 20, 30%.
Terrible.
It hurts. It hurts when you even talk about it.
Yeah.
But that's what's happening.
Yeah. Well, I can tell you about that if you want to stay on for another 20 minutes. Ramez and Jerry, thanks for this fascinating information for us smaller investors. I'm certainly in that group. But the opportunities that both of these programs offer for us, both of your companies. Ramez, I think we put your information on screen, and I'll make sure we have it in post-production. And I'm going to pull over all the information that you can get for Golf Suites and ERC with Ryan Ellenberg. And gentlemen, thank you yet again for your time. And we're going to call it a webinar.
Okay, great. Thanks for producing this, Grant. You've done a great job. Thanks so much.